Hello, traders. Gary Wagner here. It is approximately 1:23 in Honolulu, 6:23 in New York on Wednesday, 9th day of November 2022, and this is the daily report for gold and silver. After hitting basically a triple bottom on Thursday of last week, we saw gold have significant gains, trading from approximately 1630 on Friday to today's high of 1725. However, gold has retraced a little bit. Currently, December futures are down $6.30, about 0.4%, and fixed at $1,709.70. We do have an open order in which we are trying to go long just under 1700. We'll talk about that when we pull up some charts. But even today's moderate decline is really tempered because of dollar strength. The US dollar is up 0.7%. It is currently fixed at 110.325, and considering that you've got a 0.7 in terms of a rise in the dollar and about a 0.4 decline, you can see that the differential between those two, or 0.3, represents buyers bidding gold prices higher. Silver is lower today, down by 1.78% or 38 cents, with the most active December contract currently fixed at $21.12. Today's show will have a slightly different focus than most daily reports. We will look at an interim term model based on Elliott wave as well as Fibonacci extension. But first, to our active business, we do have an open position in which we're looking to enter a long position in December gold on a limit order at 1696. We currently have gold trading between 1707 and 1709. Putting it down on the day, this small line here represents activity in Australia. We have been addressing the multitude of fundamental events that have been affecting the market and, quite frankly, taking gold dramatically lower. They are raising interest rates by the Fed and the current level of inflation. However, I want to change that up today in that I want to present one of the models that I've been currently developing for our interim term estimate of 2023 as we get closer to the end of this year. The model that you see up on the screen uses two primary technical studies. First, Elliott wave count. Second, Fibonacci extension. Of course, we use the Elliott wave count to determine where in a trend we are, because even an uptrend is a series of peaks and valleys. And as you know, Elliott wave believes that you can define a bull market to a basic 8 count based on two stages: the motive phase, where you'll have waves 1 through 5, where 1, 3, and 5 represent impulse waves moving in the primary trend direction, and corrective waves 2 and 4. For the case of this model, we are looking at an interim count, and we're assuming that this is the conclusion of our wave 2. We have plotted our wave 3 here, and then we go into a subcount in A, a B, and then a C, and that C also completes the fourth wave. So simply put, what we are doing is projecting where the fifth wave could terminate if in fact we are correct with this model and we have seen lows that have come in to end this most recent leg of the correction. If that's the case, what we are doing is we're looking at the last rally, and that's this rally right here from $1,670 up to the record high this year at about $2,078. And then we look at the correction, and then we plot our extension from the termination of the correction or the beginning of wave 5. I believe the most plausible places to look in terms of the extension is going to be a 1.618 extension and a shorter extension based on a 1.382 extension. So if in fact this model holds any weight, we are looking for gold to have the possibility of breaking the all-time record high, or $2,181. That would beat the current record by about $100 to a high of about $22.75, and that of course is based upon a 1.618 extension. That is where I am forecasting gold to hit by the fourth quarter or end of 2023. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.